Hello everyone, welcome back to our class 12 economics series. In the previous video, we understood the basics of macroeconomics, circular flow of income, economic agents and the difference between stock and flow. Today we are going to study four very important concepts that are repeatedly tested in CBSE Board Examinations. These are factor income, transfer income, domestic territory, normal residence. These topics are essential because they help us understand how national income is measured correctly. So let's begin with factor income. So today's lesson builds the foundation for the calculation we will do later in the chapter. So once you understand who earns income, where production takes place, and who is considered a normal resident, concepts like GDP and GNP become much easier. So let's first understand factor income. So whenever a person provides a factors of production, that is land, labor, capital or entrepreneurship, they receive income in return. This income is called as factor income. For example, if you work in a company, you receive wages or salary for your labor. If you own a land and rent it out, you earn rent. If you lend money, you receive interest. And if you start a business and you earn from it, that income is profit. So a simple way to remember this is factor income is equals to income earned by contributing to production. So there's a very good board exam tip. Factor income is earned because a productive service has been provided. Okay. So now let's look at transfer income, which is very different. Transfer income is received or money received without providing any productive service. For example, parents giving pocket money, or government paying an old age pension, or a student receiving a scholarship, or someone receiving a gift on their birthday. So in all these cases, the receiver gets money, but they haven't produced anything or any goods or services in exchange. So that's why transfer income is not included while calculating national income, because national income measures only income generated through production. So there's a quick memory trick. Factor income means work done. Transfer income means no work done. That is why it won't be included in national income. So this comparison is extremely important for board examination. Whenever you see an income in a question, ask yourself one question. Was a productive service provided? If the answer is yes, it's a factor income. If the answer is no, it's a transfer income. This one question will help you answer many MCQs and case study questions correctly. So now let's understand domestic territory. Many students think domestic territory simply means geographical boundaries of India. That's not completely correct. Domestic territory includes all areas where the country's economic activities takes place. For example, India's political boundaries, Indian ships and aircraft operating anywhere in the world, Indian embassies and consulates in foreign countries. However, a foreign embassy located in India are not a part of Indian domestic territory because they belong to their countries, or for their economic purpose they will calculate that income. So now let's test your understanding. So now tell me, is the Indian embassy in Washington DC part of India's domestic territory? Indian embassy in Washington DC, is it a part of Indian democratic or domestic territory? Yes, answer is correct. What about US embassy in New Delhi? Correct, it's no. Similarly, Air India aircraft flying over Europe is still considered part of India's domestic territory because it is operated by an Indian resident enterprise. So these examples are often asked in the form of MCQs. Now let's understand the concept of normal resident. A normal resident is a person or institution whose center of economic interest lies in a country, generally for 1 year or more. This does not depend on nationality. For example, Indian company is a normal resident of India. A foreign company that operates in India for a long period may also be treated as normal resident of India for economic purposes. On the other hand, an Indian tourist visiting other country for 2 weeks is still considered a normal resident of India. So now there is a quick quiz. Quickly pause the video Read the question and drop your answers in the comment box. Let's see who answers correctly. I'll pin the correct answers. So today we learned how to distinguish between factor income and transfer income, explored the meaning of domestic territory, and understood who is considered a normal resident for national income accounting. These concepts are essential because they help us correctly classify income while calculating national income. In the next lesson, we will cover gross investment, net investment, depreciation, gross versus net concepts, domestic versus national concepts, and market price versus factor cost. So if you found this video helpful, please like the video, subscribe to the channel, and share it with your classmates. See you in the